Welcome to our channel. We are so glad you found your way here. Let us help you fall asleep. Let's begin with the quiet collapse of Baring Brothers, the fall of the historical British bank. Take a slow, deep breath in and release it. Even the tallest towers eventually quiet down. Tonight, we gently explore the empty boardrooms and forgotten ambitions of the past. Your mind is calm, and we are ready to begin. Established in the late 18th century, Baring Brothers emerged amidst a backdrop of significant economic transformation. The burgeoning British Empire fostered an environment ripe for trade and finance, allowing the institution to flourish as a merchant bank. Founders Francis and John Baring recognized the potential of international commerce, aligning their operations with the needs of an expanding market. Their early ventures capitalized on burgeoning industries, notably cotton and sugar, which laid the groundwork for the bank's future endeavors. It expanded its reach, establishing connections with prominent figures in finance and politics. This network provided the necessary leverage to facilitate loans and investments, supporting the growth of both the bank and the British economy. The institution played a pivotal role in funding various governmental projects, including infrastructure, which further cemented its position within this evolving financial landscape. As the 19th century unfolded, Baring Brothers solidified itself as a key player in the world of finance. It navigated the complexities of economic cycles with a mixture of acumen and ambition, becoming synonymous with British banking prestige. This period marked a time of expansion and innovation, as the bank adapted to the shifting demands of commerce and investment, setting the stage for its eventual prominence in the global arena. The foundations laid during these formative years would echo through the corridors of its storied legacy. A burgeoning economic landscape marked the 18th century in London. This period witnessed an unprecedented rise in trade and commerce, creating an environment ripe for financial institutions to flourish. Banks began to emerge, establishing themselves as crucial intermediaries in this evolving marketplace. The expansion of overseas trade routes fostered immense wealth, prompting merchants to seek more sophisticated means of managing their capital. In this burgeoning climate, the introduction of joint stock companies allowed for greater investment opportunities, laying the groundwork for modern banking practices. Emerging from this milieu, several institutions adapted quickly to the changing economic realities. They provided essential services, such as loans, deposits, and currency exchange, which became vital for merchants and entrepreneurs seeking to navigate the complexities of commerce. These banks not only facilitated transactions, but also served as a stabilizing force within the rapidly growing economy. The interconnectedness of these financial entities fostered an atmosphere of innovation, encouraging the establishment of more specialized banking functions. This region became a hub for financial activity, attracting ambitious individuals and fostering a competitive spirit among institutions. The establishment of the Bank of England in 1694 further exemplified the significance of banking during this era, solidifying London's status as a premier financial center. The intricate web of finance laid during these years would later influence the trajectory of Baring Brothers and the very fabric of British banking. Founders and influencers played pivotal roles in shaping the early years of Baring Brothers. This institution emerged from the aspirations of John Baring, who, alongside his siblings, established a trading company in the late 1800s. Their vision extended beyond mere commerce, as they laid the groundwork for a banking enterprise that would flourish amidst the Industrial Revolution. A keen understanding of emerging markets and a relentless pursuit of opportunity characterized their approach. The legacy continued with subsequent generations, notably Francis Baring and his nephew, who possessed a remarkable ability to navigate the complexities of foreign trade. These individuals leveraged their connections and acumen, positioning the firm to capitalize on significant events such as the Napoleonic Wars. The expansion into government bonds and international finance marked a strategic pivot, showcasing their adaptability in a rapidly changing environment. As the years unfolded, the leadership of Baring Brothers attracted influential figures from various sectors, including politics and industry. Their insights and alliances further entrenched the bank's prominence within London's financial landscape. Through calculated risks and visionary strategies, they cultivated a reputation that resonated throughout Europe, solidifying their role in the burgeoning global economy. This foundation would prove essential, as the intricate dynamics of finance and trust would later face unprecedented challenges. Baring Brothers emerged as a pivotal institution during the Napoleonic Wars, facilitating the movement of capital that sustained the British military efforts against France. Their expertise in international finance allowed them to navigate the turbulent waters of war, establishing themselves as key lenders to the British government. This involvement did not merely reflect a commitment to national interests, it also highlighted a growing confidence in their financial acumen. They orchestrated vast loans, amounting to several £million, necessary for purchasing arms, supplies, and troop logistics. These transactions solidified their reputation, positioning the bank as a cornerstone of Britain's wartime economy. The establishment of a network of relationships across Europe enabled them to command a unique vantage point, balancing risk and opportunity amidst chaos. With each loan secured, they fortified their influence, intertwining their fate with that of the British Empire. The war generated substantial profits for the bank, allowing it to expand its operations and clientele. The financial strategies employed demonstrated an understanding of both market dynamics and the intricacies of sovereign lending. This period marked the zenith of their power, yet it also sowed the seeds of complexity in their dealings. Successes during this era would later cast long shadows, as the shifting tides of fortune would challenge their legacy in unforeseen ways. The transition to investment banking began amid the swell of the Industrial Revolution. This era ushered in unprecedented growth, redefining economic landscapes and prompting a demand for capital. Baring Brothers, recognizing this shift, sought to expand their operations beyond traditional merchant banking into the realms of underwriting and advisory services. They embraced the burgeoning needs of industrialists, facilitating monumental projects that transformed entire sectors of the economy. Investment in railroads, factories, and emerging technologies became the focus, as they aligned themselves with the aspirations of a new class of entrepreneurs. The firm established itself as a vital conduit for funding, connecting innovative ventures with eager investors. Success came in waves, marked by lucrative deals that bolstered their reputation and financial strength. Yet this rapid expansion introduced complexities. Increased exposure to volatile industries and the inherent risks of speculative ventures began to strain their operations. As the landscape evolved, Baring struggled to maintain their foothold, caught between the demands of traditional banking and the unpredictable nature of investment. The delicate balance they once held began to waver, revealing vulnerabilities that would soon come to define their journey. What had once been a symbol of stability now faced uncertainty as economic conditions shifted and the firm grappled with the repercussions of its transformation. International expansion marked a pivotal chapter in the narrative of this historical bank. The allure of new markets beckoned, prompting a strategic pivot towards global operations. Branches sprouted across continents, from the bustling streets of New York to the burgeoning trade hubs of Asia. This ambitious reach was underpinned by an extensive network of relationships with governments and corporations, establishing Baring Brothers as a critical intermediary in international finance. The firm embraced the opportunities presented by the evolving global economy. They facilitated significant transactions, offered investment services, and became synonymous with high-stakes financing. In this period, it cultivated a reputation for innovation, adapting traditional banking practices to meet the demands of an increasingly interconnected financial landscape. While growth seemed steady, the complexities inherent in operating across diverse regulatory environments began to surface. The challenges of navigating foreign markets, combined with the intricacies of international law, tested the firm's resilience. Each new venture brought with it a unique set of risks, as local economies fluctuated and geopolitical tensions emerged. Success was accompanied by vulnerability. The rising tide of competition intensified, with emerging financial institutions vying for market share. In this evolving context, Baring Brothers found itself not only expanding its reach, but also grappling with the delicate balance between ambition and the looming specter of instability. Innovative financial instruments emerged as a hallmark of Baring Brothers during its growth phase. This institution played a pivotal role in the development of securities that catered to an expanding market. By crafting new financial products, it sought to attract a diverse clientele, including governments and large corporations, while establishing itself as a leader in global finance. The emergence of these securities reflected a larger trend within the industry, where the demand for sophisticated investment vehicles increased. Each new instrument represented an effort to harness confidence and facilitate investment in burgeoning economies. They were met with both enthusiasm and skepticism, leading to a complex interplay of risk and reward that defined this period. Baring Brothers engaged in underwriting bonds and equities, leveraging its long-standing expertise to navigate this intricate landscape. The introduction of derivatives further illustrated the bank's innovative spirit, providing clients with tools to hedge against fluctuations in the market. These developments initially seemed to solidify its position. However, the inherent risks embedded within these instruments began to surface. As the appetite for such products grew, so too did the potential for mismanagement and overextension. The very innovations that once promised prosperity began to cast shadows, revealing vulnerabilities that would later contribute to the bank's decline. The delicate balance between innovation and stability shifted, setting the stage for an uncertain future. The emergence of the Bank of England in the year 1694 marked a significant turning point in the financial landscape. Baring Brothers played a pivotal role in this evolution, acting as both a facilitator and participant in the early banking system. Their influence extended beyond mere transactional relationships. They helped shape the regulatory environment that would govern financial institutions for centuries. In those formative years, the partnership engaged in various financial ventures, providing essential services to the nascent government in need of capital. Through bond issuance and treasury management, Baring Brothers established itself as a trusted advisor, navigating the intricacies of public finance. This relationship with the government allowed them to influence monetary policy, reinforcing their position at the heart of British financial affairs. As the Bank of England solidified its authority, Baring Brothers adapted to the shifting dynamics. The demands of an expanding economy necessitated a more robust banking framework, and the firm responded with innovation in financial instruments and practices. Their engagement in foreign trade and investment further enhanced their reputation, connecting them to global markets and emerging economies. The legacy of their contributions during this era laid the groundwork for future banking practices, intertwining their fate with that of a burgeoning financial institution that would. Baring Brothers' involvement in major railroads epitomized their role as a financial powerhouse in the 19th century. They provided crucial capital for extensive railway projects, enabling the expansion of infrastructure that would connect cities and stimulate economic growth. This initiative not only facilitated trade and transportation, but also solidified the bank's reputation as a leader in funding large-scale ventures. Through strategic financing, they became instrumental in developing rail networks across the United Kingdom and beyond, investing in ambitious projects that shaped the landscape of commerce. These endeavors allowed for an increase in productivity and the movement of goods, transforming both local economies and international trade routes. The bank's intricate connections with railroad companies underscored its influence and reach, marking a period when financial institutions played a vital role in industrialization. As railroads thrived, so did the bank's fortunes, fostering a symbiotic relationship between infrastructure development and financial growth. However, the very dependencies that propelled prosperity began to reveal vulnerabilities. External factors such as economic downturns, shifting political landscapes, and increasing competition placed pressure on these financial arrangements. Over time, the once prominent institution found itself navigating a landscape fraught with challenges, as the infrastructure they funded became both a symbol of achievement and a precursor to impending decline. The Great Irish Famine marked a profound turning point, deeply affecting both the economy and the societal fabric of Ireland. This catastrophe, with its widespread devastation, placed immense pressure on financial institutions, including the historical bank. Investments in the region, once seen as secure and promising, rapidly deteriorated under the weight of mass starvation and emigration. The economic landscape transformed dramatically, leading to significant losses for those who had banked on agricultural prosperity. With the agricultural sector collapsing, it became clear that reliance on these investments was misguided. The bank's exposure to the Irish economy intensified as the agricultural failures directly impacted their financial health. Merchants and landowners, once robust clients, faced insolvency, leaving the institution grappling with increased defaults. The famine, characterized by the blight that decimated potato crops, also spurred a wave of social unrest. This unrest further destabilized the region, complicating recovery efforts. The institution's involvement in financing infrastructure projects aimed at alleviating the crisis soon turned into a burden rather than a boon. As the years passed, the ramifications of these investments became evident, revealing the fragility of the bank's once esteemed position. The decline was not merely a financial matter. It represented a broader story of miscalculation and the unpredictable nature of socioeconomic interdependence. This period marked an era of exceptional growth for the institution, propelled by the rapid expansion of trade and industry in the United Kingdom and abroad. The Baring brothers capitalized on the emerging markets, establishing a robust network that facilitated capital flows across borders. With their adeptness in financial innovation, they ventured into underwriting government bonds and financing major infrastructure projects, thus embedding themselves in the very fabric of the global economy. Their strategy intertwined with the burgeoning demand for railways, telegraphs, and shipping, which not only generated substantial profits, but also contributed to an expanding economic influence. This bank became synonymous with trust and reliability, attracting a diverse clientele ranging from wealthy individuals to burgeoning enterprises seeking investment capital. The firm's ability to adapt to changing market conditions underscored its resilience during this prosperous time. Branches opened in key cities, solidifying their presence in international finance. Relationships with foreign governments and businesses flourished, positioning the institution as a pivotal player in global economic dynamics. Yet, within this landscape of growth, underlying vulnerabilities began to emerge. The interconnectedness of markets introduced risks that were often underestimated, setting the stage for future challenges. As prosperity continued, the very strategies that once heralded success would later encounter the complexities of an evolving financial world. The influence of the gold standard on operations became increasingly pronounced as the 19th century progressed. This monetary system, which tied currency values to gold, initially provided a framework of stability and predictability. It enabled Baring brothers to expand their activities across international markets, facilitating trade and investment in a way that underpinned their growth. The allure of the gold standard lay in its promise of monetary discipline and the confidence it inspired among investors and clients. As gold became the bedrock of financial transactions, this institution thrived in a world where trust was paramount. The firm capitalized on opportunities presented by burgeoning industries and overseas ventures, cementing its reputation as an essential player in global finance. The reliance on gold reserves created a sense of security, allowing it to engage in large-scale lending and underwriting operations. However, this dependency also rendered it vulnerable to fluctuations in gold prices and shifts in public sentiment regarding the currency's stability. Changes in economic conditions could create ripples, exposing cracks in the very foundation of its business model. What once appeared as a bastion of strength now faced challenges that arose from the rigidity of the system. As the world moved towards greater financial complexity, the constraints imposed by the gold standard would soon reveal their limitations. This institution cultivated a reputation that attracted influential clientele and forged strategic partnerships. Established in 1792, it became synonymous with financial prudence and expertise. Wealthy merchants and industrialists sought the bank's counsel, drawn by its extensive network and the promise of sound financial advice. The institution's early involvement in financing trade and infrastructure projects helped solidify its standing. Clients included aristocrats and burgeoning industrialists who found in it a reliable ally during the expansion of the British Empire. Relationships with key figures across various sectors bolstered its influence, allowing it to navigate the complexities of international finance with relative ease. Over decades, these connections transformed into a stable foundation, propelling the firm into the upper echelons of financial institutions. Successful partnerships with foreign governments and other banks facilitated the bank's growth and diversification. It became a pivotal player in the financing of railroads and public works, extending its reach beyond the British Isles. As the institution flourished, its name became a symbol of trust and reliability. Yet, beneath the surface of this gilded reputation lay vulnerabilities that would be tested in the evolving landscape of global finance, where new challenges awaited. The foundation, once solid, began to show signs of strain. The financial landscape during the American Civil War revealed the intricate connections that Baring brothers had forged across the Atlantic. This institution, once a beacon of stability, became a critical player in the funding of the Union effort. They facilitated loans that provided essential resources, reflecting a confident engagement with the challenges of that era. Their dealings were marked by an understanding of the complex political tensions. They extended credit to the Union government at a time when cash flow was paramount for sustaining military operations. The bank's role as an intermediary allowed it to leverage European capital, drawing investment that would bolster the Northern cause. This involvement, however, was not without its complications. Baring brothers navigated a landscape fraught with uncertainty. The risks associated with financing a war were significant, yet the potential rewards kept them deeply invested. They maintained an intricate web of relationships with both American and European investors, showcasing their adeptness in global finance. Despite these efforts, the burdens of such high-stakes involvement began to weigh heavily. The strain from fluctuating interest rates and political instability in both regions started to erode their previously unshakable position. The consequences of this engagement, while initially promising, would later contribute to an unraveling of stability within the institution itself. The evolution of financial regulation began to take shape in response to increasing complexities within the market. As these changes unfolded, the institution faced mounting pressure to adapt its practices. This period marked a significant transition, with regulatory bodies introducing measures aimed at enhancing transparency and accountability. Embracing these adjustments was essential for survival. The institution had to reassess its risk management protocols, as the previous models no longer aligned with the newly established standards. It implemented a series of internal reforms designed to bolster compliance and safeguard against potential vulnerabilities. This environment fostered an atmosphere of cautious innovation, yet the adaptation often felt more reactive than proactive. New regulations demanded stricter oversight of financial instruments and enhanced reporting requirements. The institution's ability to navigate these waters became increasingly critical as market dynamics shifted. They were compelled to invest in sophisticated compliance systems, diverting resources from other areas. This redirection limited growth opportunities as the focus turned inward, prioritizing regulatory adherence over expansion. Challenges continued to mount, with the institution striving to balance operational integrity against the backdrop of an ever-changing landscape. The efforts made were commendable, but they often fell short in the face of more agile competitors. This struggle underscored the inherent difficulties of adaptation within a framework of rigid regulatory expectations. The war initiated a seismic shift in the financial landscape, forcing institutions like Baring Brothers to confront unprecedented challenges. The demand for capital soared as nations mobilized, seeking funds to support military expenditures. This environment compelled the bank to reassess its traditional lending practices and risk appetite. Strategic responses emerged as the institution endeavored to navigate the complexities of wartime finance. Efforts were made to enhance relationships with government entities, positioning itself as a trusted partner in financing war efforts. Baring Brothers undertook the issuance of war bonds, a pivotal move aimed at harnessing public support and inflating liquidity during this tumultuous period. Challenges were not limited to opportunity. The bank grappled with the volatility of international markets as trade routes became disrupted and foreign investments soured. The pre-war stability that had characterized its operations began to erode, revealing vulnerabilities previously masked by decades of success. This period marked a significant transformation in the institution's identity. The reliance on traditional banking practices became increasingly untenable as the realities of conflict dictated the need for innovation and flexibility. With each strategic response, it became apparent that the very foundation of Baring Brothers was being reshaped, reflecting the broader transformations taking place within the banking sector during and after the war. The interwar period marked a time of profound challenges and changes for the fading company. Economic instability permeated the region, characterized by fluctuating currencies and the aftermath of the Great War. This environment strained financial institutions, compelling them to adapt to a landscape that was increasingly volatile and unpredictable. Baring Brothers found itself grappling with a shift in client demands and investment strategies. Traditional methods, once a hallmark of its operations, began to yield to innovative approaches favored by emerging competitors. The bank's leadership faced the dual challenge of retaining its historic clientele while appealing to a new generation of investors drawn to higher-risk opportunities. Amidst these evolving dynamics, regulatory pressures intensified. New legislation aimed at safeguarding financial markets required Baring Brothers to reassess its compliance frameworks. The once loyal client base began to question the bank's adaptability in a rapidly changing financial climate. This period also witnessed a gradual decline in the bank's dominance within the sector. With each passing year, its influence waned as rival institutions capitalized on modern financial practices. The inability to fully embrace these transformative changes contributed to an erosion of confidence. The economic climate during the Great Depression significantly impacted operations. Faced with a global downturn, the institution struggled to maintain its previous levels of profitability. Demand for financial services diminished, leaving many clients unable or unwilling to engage in transactions that once sustained the bank's revenue streams. This shift in client behavior created a ripple effect, forcing the bank to reassess its lending practices and investment strategies. Investment portfolios, once viewed as secure, began to deteriorate. The market's volatility placed immense pressure on the bank's assets, triggering a wave of losses that compounded over time. With liquidity tightening, it became increasingly challenging to navigate the landscape of reduced consumer confidence. The decline in trade volumes further exacerbated the situation, leading to a substantial reduction in fees and commissions. This region, once bustling with financial activity, began to reflect the broader economic malaise. The bank's once thriving branches experienced a decline in foot traffic, as potential customers turned to alternatives or withdrew entirely from the financial system. Internal management found itself grappling with a dual challenge, addressing the immediate financial crisis while trying to restore trust among shareholders and clients. The new economic order presented opportunities, yet it was an era fraught with uncertainty. This institution sought to navigate the changing landscape, where globalization and technological advancements began to redefine banking. Strategies were developed to adapt, focusing on expanding into emerging markets that promised growth potential. It aimed to leverage its historical reputation to attract foreign investment, believing that its legacy would offer a competitive advantage in this new environment. Challenges arose as established competitors embraced innovation and restructured their operations. The firm's reluctance to fully embrace digital banking left it vulnerable, while others surged ahead with online services and automated systems. This institution appeared to cling to traditional practices. Efforts to modernize were often met with internal resistance, complicating progress toward a more agile framework. Amidst these developments, the changing regulatory landscape required compliance with stricter financial oversight. This added layers of complexity to operations, stretching resources thin. The firm endeavored to reassure stakeholders, but trust continued to erode, influenced by perceptions of stagnation. As the years progressed, market volatility and economic shifts posed additional hurdles, testing the resilience of this once mighty institution. The weight of history became both a burden and a beacon, as it struggled to redefine its place in an increasingly competitive global market. The Bretton Woods Conference marked a significant moment in global economic history, a time when nations sought stability and collaboration in the wake of World War II. Baring Brothers found itself positioned at the intersection of finance and diplomacy, lending its expertise to the discussions that would shape the international monetary system. This institution, steeped in tradition, was a key participant, embodying the financial acumen that had once propelled it to prominence. The firm provided crucial insights into the mechanics of capital flows and currency management. Its representatives engaged with delegates from various countries, advocating for frameworks that would facilitate economic recovery and interdependence. The atmosphere in this conference was charged with optimism, as participants envisioned a future of cooperative economics. Baring Brothers, with its considerable experience in international finance, contributed to the development of institutions that would later become pillars of the global economy, such as the International Monetary Fund and the World Bank. As the discussions unfolded, Baring Brothers aimed to reinforce its relevance in a rapidly evolving landscape. The firm's presence was a reminder of its historical significance, yet it faced challenges that hinted at the shifting tides of the banking sector. The environment was one of cautious hope, yet the undercurrents of change were becoming increasingly palpable. The transition towards global finance marked a pivotal moment for this institution, pushing it to adapt in ways that once seemed unfathomable. Strategies were developed to embrace new markets and diversify services, reflecting the shifting landscape of financial operations. Innovative financial instruments began to appear, designed to attract a more extensive clientele. Branches opened in emerging economies, with a keen focus on Asia and the Americas. The intent was clear: to capture a share of the increasing wealth generated by globalization. It was a calculated response to the challenges posed by competitors who were also expanding their reach. Investment in technology became a priority as systems were upgraded to handle the complexities of international transactions. Staff underwent extensive training, preparing them for the demands of a rapidly evolving financial world. Yet, even with these efforts, the underlying issues of risk management remained unaddressed. As time progressed, the initial enthusiasm began to wane. The very markets that promised growth also brought volatility, leading to increased pressure on the institution's financial health. The cautious hope that once defined the atmosphere transformed into a sense of unease. Strategic decisions, once bold and innovative, began to lose their effectiveness as the realities of the global market proved more challenging than anticipated. The 1960s brought a period of optimism and expansion for a prominent British institution. Financial innovation flourished as new products and services were introduced, catering to the evolving demands of the market. This era saw a surge in mergers and acquisitions, allowing it to diversify its offerings and enhance its competitive edge. The institution embraced advancements in technology, leading to streamlined operations and improved efficiency. Investment strategies became increasingly sophisticated, focusing on emerging markets and industries. This financial institution played a crucial role in facilitating international trade, positioning itself as a key player in global finance. The atmosphere was one of excitement as opportunities seemed boundless. Amidst this growth, the bank's reputation soared, bolstered by its daring ventures into new realms of finance. It adeptly navigated the complexities of foreign exchange and capital markets, often ahead of its peers. The leadership exuded confidence, promoting an image of resilience and foresight. Yet, while the financial landscape was evolving, so too were the risks associated with such rapid change. The reliance on innovative investment strategies led to unforeseen vulnerabilities. The fast-paced environment, once a source of strength, began to harbor the seeds of future instability. The balance between ambition and caution grew precarious, setting the stage for challenges ahead. Strategic missteps began to emerge gradually, eroding the foundation of this historical institution. Decisions made in the boardroom prioritized short-term gains over the long-term stability of the bank. The allure of lucrative investments in riskier markets led to an overexposure that would soon become apparent. Those entrusted with safeguarding the financial health of the organization overlooked the importance of a diversified portfolio. A reliance on outdated models of banking contributed to an inability to adapt to the rapidly changing environment. Competitors embracing innovation and technology gained a foothold, leaving it at a disadvantage. The atmosphere shifted as whispers of mismanagement and inefficiency permeated the organization. Internal conflicts arose, resulting in a fractured culture that stifled collaboration and responsiveness. As the market began to shift, external pressures mounted. Regulatory changes and increasing competition forced this bank to confront its vulnerabilities. The once coveted reputation began to tarnish, with clients reevaluating their loyalty amidst growing instability. The culmination of these factors created a perfect storm. Losses mounted alongside a decline in investor confidence, and the institution found itself grappling with the consequences of its previous choices. This precipitated a slow unraveling, marking a critical juncture in the history of traditional banking. A legacy built over centuries began to fade, overshadowed by the weight of strategic miscalculations. An increasing number of financial institutions began to emerge, each one vying for a share of the market once dominated by a select few. This region witnessed the rapid ascent of competitors that adopted innovative practices and embraced cutting-edge technology, resulting in a shifting landscape of financial services. Traditional banks found themselves at a crossroads where adaptability became essential for survival. Baring Brothers, long regarded as a stalwart in the banking world, faced challenges from these upstarts. Their once esteemed reputation began to erode as nimble competitors captured the attention of investors with enticing products and efficient services. Customers gravitated toward institutions that offered ease and accessibility, leaving Baring Brothers to grapple with an outdated model. The intense rivalry further strained the organization's resources, revealing vulnerabilities in their operations. The inability to pivot quickly in response to the changing environment resulted in diminishing returns. It became increasingly evident that the storied bank had not only lost its market position, but also its competitive edge. This decline was compounded by a failure to effectively communicate the value of their services. As trust eroded, the once loyal clientele began to explore alternative options. What remained was a fading entity, struggling to navigate a complex and unforgiving realm where innovation reigned supreme. A fading entity, struggling to navigate a complex and unforgiving realm where innovation reigned supreme, attempted to adapt. The rise of risk management became a focal point, a response to a series of financial crises that had shaken the foundations of the banking sector. A realization emerged that traditional methods could no longer sustain operations in an increasingly volatile market. In this shifting landscape, it adopted new frameworks and strategies to mitigate exposure to potential losses. Sophisticated models began to surface, designed to assess various types of risk. Analysts scrutinized data with precision, seeking patterns that could illuminate the path forward. This proactive stance towards risk management represented a significant departure from previous practices. Investment in technology became paramount, with resources allocated to enhance analytical capabilities. The integration of quantitative assessment tools aimed to provide a clearer view of the burgeoning uncertainties inherent in the financial environment. The use of these tools allowed for a more comprehensive evaluation of credit risk, market fluctuations, and operational vulnerabilities. Despite these efforts, the bank found itself ensnared in a web of challenges. It faced an uphill battle against competitors who had already established robust risk management systems. While the initiatives reflected a necessary evolution, they proved insufficient to reverse the tide, leaving the institution teetering on the brink of collapse. The decade of the 1980s marked a significant turning point, characterized by sweeping deregulation within the financial sector. This environment presented Baring Brothers with a duality of potential opportunities and inherent risks. Freed from many previous constraints, the institution sought to expand its operations, venturing into new markets and innovative financial products. It embraced the allure of increased profits that came with these unregulated territories. The emergence of sophisticated financial instruments, including derivatives, attracted the attention of the firm. The desire for growth propelled it into unfamiliar arenas, where the promise of high returns overshadowed the caution typically exercised in traditional banking practices. This pursuit of ambition gave rise to a more aggressive trading culture, where risk became an intrinsic part of daily operations. Yet as the institution pursued these aggressive strategies, the very foundation that had sustained it began to weaken. The embrace of risk management practices was often superficial, leaving vulnerabilities exposed. Employees, motivated by the allure of substantial bonuses, engaged in speculative trading, often overlooking the underlying dangers. The landscape became increasingly treacherous as external market conditions fluctuated wildly. Amidst this burgeoning chaos, the once stalwart institution began to lose its footing, setting the stage for a gradual unraveling. Each decision, influenced by the era's fervor, contributed to a precarious balance that would eventually tip into crisis. The introduction of cutting-edge technologies marked a significant period for the institution. Innovations in communication, such as the telegraph, allowed rapid exchange of information across vast distances. This efficiency transformed operations, enabling swift transactions and the expansion of trade networks. The bank embraced mechanization, investing in new systems to process financial data, which streamlined operations and improved accuracy. This shift positioned it as a frontrunner in adopting technology within the financial sector. A notable advancement included the implementation of early forms of computing, which analyzed market trends and risks, providing insights that were previously unattainable. By harnessing these tools, it sought to maintain a competitive edge. The rapid adoption of these technologies cultivated an environment of confidence, fostering a sense of security among investors and clients. As these innovations flourished, they attracted attention and investment, creating a facade of invulnerability. The rapid pace of technological development, however, outstripped the bank's ability to manage emerging complexities. As systems grew more intricate, vulnerabilities became apparent. The reliance on technology also masked underlying issues, leading to complacency among decision makers. In this evolving landscape, the once pioneering institution began to face challenges that would. The increasing complexity of financial products revealed a fundamental shift in the offerings of this institution. Once celebrated for its simplicity and reliability, it gradually transitioned into a labyrinth of derivatives, exotic securities, and leveraged investments. This evolution mirrored broader trends in the financial industry, where innovation often outpaced regulation and risk assessment. The allure of high returns enticed many, yet these intricate instruments often proved opaque, even to seasoned investors. Baring Brothers, once a bastion of traditional banking, began to delve into markets that demanded heightened scrutiny and sophistication. The allure of profits overshadowed caution, leading to an expansion into areas previously deemed speculative. Each new product represented a potential boon, but it also carried with it an escalating risk profile that became increasingly difficult to manage. As time progressed, the institution found itself entwined within this web of complexity, reliant on models that promised to predict outcomes, but compounding these challenges was the growing competitive pressure from both established banks and emerging financial entities. The once clear line between investment and commercial banking began to blur, leaving Baring Brothers navigating a shifting terrain. The institution struggled to maintain its identity amid this evolving financial ecosystem, leading to a gradual erosion of the trust that had been its foundation. The challenges faced in the 1990s were compounded by the rapid globalization of financial markets. This period saw a transformation in how banks operated, as the boundaries between national economies blurred. It ventured into diverse international markets, seeking growth and profits in a landscape defined by innovation and competition. This endeavor, while ambitious, exposed vulnerabilities that would prove detrimental. The firm's activities expanded into emerging markets, guided by a desire to capitalize on opportunities presented by deregulation and technological advancements. It established a presence in regions once considered too risky, drawn by the allure of high returns. Risk management protocols, however, did not keep pace with the aggressive strategies being employed. As global markets became increasingly interconnected, the impact of miscalculated decisions reverberated beyond borders. Deteriorating conditions in Asia during the late 1990s served as a stark reminder of these risks. The volatility of foreign exchanges and the unpredictable nature of political climates unsettled operations. Losses mounted, and the once revered institution found itself grappling with financial strain. Internally, the culture shifted as the pursuit of profit superseded the values that had once defined it. These decisions, which were intended to secure its future, instead contributed to a precarious existence, further unraveling the banks standing in a world that demanded resilience and adaptability. The Asian financial crisis struck in 1997, sending shockwaves through global markets and revealing vulnerabilities that had remained hidden. This tumultuous period exposed weaknesses within financial institutions, including Baring Brothers. The bank, already teetering on the brink, faced mounting pressures as its exposure to Southeast Asia intensified. Investments that once promised substantial returns began to falter, leading to significant losses. High-risk ventures in regions like Thailand and Indonesia quickly deteriorated, undermining the fragile foundation upon which the bank operated. Confidence in Baring Brothers waned as news of escalating defaults and economic instability permeated the financial landscape. It became clear that the bank was ill-prepared for the unfolding crisis, lacking the necessary strategies to mitigate risks inherent in its ambitious expansions. This downturn revealed a stark reality as market participants reevaluated their relationships with the institution. The financial community witnessed a stark decline in trust as the consequences of mismanagement began to surface. The intrinsic value of Baring Brothers diminished, leading to a swift reassessment of its role within the global banking system. In the wake of the crisis, the bank's leadership struggled to stabilize operations. Attempts to secure additional capital met with skepticism, as stakeholders questioned the viability of their investments. The once revered institution stood at a precipice, facing an uncertain future amid the ruins of its ambitious past. The allure of emerging markets lured many financial institutions, including this prominent bank. It ventured into territories rich with potential, yet fraught with volatility. Baring Brothers sought to capitalize on the growth of economies in Asia and Latin America, believing that the rewards outweighed the inherent risks. Investment decisions were made with optimism, driven by projections of exponential growth and untapped resources. Cultivating relationships with local businesses and governments, trust began to form, yet the foundations were precarious. Rapid expansion created an environment where oversight weakened. Financial instruments, once viewed as innovative, now revealed their complexity. The pursuit of profits often overshadowed prudent risk management, leading to ill-fated investments that would haunt the institution. These ventures became a double-edged sword. Returns flourished in the initial stages, emboldening further exploration into uncharted markets. Yet, political instability and economic downturns swiftly eroded gains. The unpredictable nature of these regions started to unveil the fragility of Baring Brothers' position. As losses mounted, a stark realization emerged. The very markets that promised prosperity now threatened survival. The once confident projections transformed into urgent reassessments. This institution, once synonymous with financial prowess, found itself entangled in a complex web of emerging market dilemmas, navigating the delicate balance between ambition and caution. Intensifying pressures began to emerge, revealing cracks in the foundation of this historic institution. The pursuit of growth, while commendable, increasingly overshadowed prudent risk management. In the early 1990s, it became evident that the bank's exposure to volatile markets was growing disproportionately. Strategies aimed at expanding into new territories were met with unforeseen challenges. Currency fluctuations in emerging economies began to erode profits, leading to a discrepancy between projected and actual performance. Analysts observed the rising levels of debt among corporate clients, which heightened concerns over defaults. This region, once vibrant with potential, displayed signs of unease. The appetite for risk grew insatiable, yet the fundamentals of financial stability remained elusive. Reports of irregularities surfaced, hinting at deeper issues within the banking culture. A reliance on complex financial instruments meant that the true extent of liabilities remained obscured. Employee morale began to falter as leadership wrestled with mounting pressures. The atmosphere shifted from one of confidence to a palpable sense of foreboding. Stakeholders, once steadfast in their support, started expressing doubt. The weight of impending crises loomed large, casting a shadow over strategic decisions. As awareness grew regarding systemic vulnerabilities, the response to these warnings remained uncoordinated, contributing further to the decline of this once proud institution. The timeline of events surrounding the collapse of this historic bank reveals a gradual unraveling of confidence. In the early days of the 21st century, a series of troubling reports surfaced, indicating excessive risk-taking and mismanagement within its trading operations. This institution, founded in the late 18th century, had once been a pillar of the British financial system, yet now faced scrutiny from regulators and stakeholders alike. By the year 2000, signs of distress were apparent. The firm had accumulated substantial losses due to unauthorized trading activities, notably by a single rogue trader. As these figures were disclosed, the bank's reputation began to erode, with clients withdrawing their investments. This loss of trust was compounded by a lack of decisive action from the management, who struggled to contain the emerging crisis. In February of 2001, the situation reached a critical point. The revelation of an estimated loss of over £1 billion prompted the bank to seek assistance. The British government intervened. Yet the internal mechanisms of the institution had already begun to unravel. Among the contributors to this decline was Nick Leeson, a trader whose ambitious strategies and questionable practices played a pivotal role in the bank's demise. Operating within the confines of the Singapore branch, he engaged in speculative trading. Leeson's dealings, characterized by a lack of oversight, spiraled into an abyss as he concealed his mounting debts through a web of deceit. This region became a hub of unregulated activity where unchecked risk-taking flourished. The financial instruments he utilized were complex, yet his understanding appeared to falter as losses grew. Each transaction that should have raised alarms instead deepened the silence of complicity. The bank's leadership remained largely unaware of the extent of these transgressions until it was far too late. By the time the true scale of the situation emerged, the cumulative losses reached an astounding sum, exceeding £1 billion. This figure, symbolic of the broader failure of governance and oversight, marked a crucial turning point. The consequences reverberated throughout the financial sector, resulting in loss of trust and confidence that would linger for years. The legacy of this downfall became a cautionary tale of unchecked ambition and systemic failure. Trading losses precipitated a significant financial unraveling, marked by staggering figures that illustrated the gravity of the situation. Over a mere span of weeks, the firm witnessed losses exceeding £800 million, an amount that echoed through the financial halls of London and beyond. These figures did not merely reflect poor trading decisions, but rather systemic issues rooted deeply within the organization. As trades turned sour, the strain became palpable. The once sterling reputation of this institution began to erode, revealing vulnerabilities that had long remained obscured. The abrupt realization of these losses sent ripples through the markets, engendering a pervasive atmosphere of uncertainty. Financial partners grew wary, and trust disintegrated like sand slipping through fingers. The decline of this venerable bank also had broader implications. The shockwaves extended into the global financial system, impacting liquidity and investor confidence. Rival institutions scrutinized their own risk management practices, recognizing the fragility that often lay beneath the surface of stability. Regulatory bodies initiated reviews, seeking to comprehend the failures that led to such an unprecedented collapse. This moment became etched in financial history, a stark reminder of the consequences that accompany reckless speculation and inadequate oversight. The fall of Baring Brothers lingered as a lesson in the annals of banking, forever altering the landscape of financial operations. Regulatory oversight proved insufficient in addressing the mounting pressures faced by this historical institution. As risks accumulated, the mechanisms designed to safeguard against such failures faltered, revealing vulnerabilities in the financial system. The absence of stringent controls allowed reckless trading strategies to flourish unchecked, leading to significant losses. In this environment, the desire for profit overshadowed prudent risk management. The complexities of financial instruments used by Baring Brothers made it difficult for regulators to understand the full extent of the impending crisis. This region of finance became increasingly opaque, with derivatives and leveraged positions contributing to a growing web of risk. The failure to recognize these factors indicated a broader issue within the regulatory framework, which struggled to adapt to the rapidly changing landscape of global finance. Subsequently, the reliance on self-regulation within the banking sector proved detrimental. Institutions operated under the assumption that they could manage their risks effectively without external intervention. This misplaced confidence set the stage for catastrophic decisions. As the situation unfolded, the revelation of extensive losses highlighted the shortcomings in the oversight processes. The lack of timely intervention facilitated a decline that would resonate throughout the financial community, prompting a reevaluation of regulatory practices in the years that followed. The absence of effective risk management systems marked a significant factor in the downfall of the institution. Such systems, intended to identify and mitigate potential threats, were often neglected or inadequately implemented. This negligence created an environment where unchecked risks proliferated, leading to decisions based on flawed analyses and assumptions. The tools designed to safeguard the institution's assets became obsolete, failing to adapt to the rapidly evolving financial landscape. In this climate, speculative ventures took precedence over prudent investments. Unforeseen market shifts exposed vulnerabilities that were previously obscured by overconfidence. The reliance on outdated models and a failure to account for systemic interdependencies resulted in cascading failures. This oversight became painfully evident as the impact of external shocks reverberated throughout the organization. The reliance on quantitative metrics, while valuable, proved insufficient in capturing the complexities of emerging risks. The inability to pivot in response to changing circumstances eroded trust among stakeholders. This eroded trust. As the institution faltered, the ramifications extended into the broader economic framework. Regulatory bodies took note, initiating inquiries into the effectiveness of risk management practices across the industry. The lessons learned from this decline would shape future approaches to risk, forever altering the landscape of financial oversight. Initial reactions to the collapse were marked by a sense of disbelief, as the financial world grappled with the implications of such a storied institution's demise. Stakeholders were left in a state of uncertainty, reflecting on the trust that had been placed in the one stalwart establishment. Investors sought refuge in safer assets, leading to a ripple effect across markets that were already fragile. This period was characterized by a collective reevaluation of risk, as financial analysts dissected the events that led to the downfall. Responses from regulatory bodies emerged swiftly, with calls for more stringent oversight. New measures were proposed to enhance transparency and accountability within financial institutions. The banking sector was compelled to reassess its methodologies, focusing on risk management strategies that had previously been sidelined. This shift was evident in the increased scrutiny of leverage and exposure. In the public sphere, the collapse ignited discussions about the ethical responsibilities of banks. Voices from various sectors demanded greater corporate governance, emphasizing the need for integrity in financial operations. The consequences extended beyond immediate financial losses. They sparked a cultural shift in how institutions approached their fiduciary responsibilities. This period of reflection and response marked the beginning of a new era in banking, where the lessons from the past became integral to shaping future practices. The investigation into Baring Brothers' practices began with meticulous scrutiny of their trading strategies and risk management protocols. It became evident that a culture of complacency had taken root, where unchecked ambition overshadowed prudent oversight. Analysts discovered layers of complexity within their financial instruments, obscured by a veil of confidence that masked inherent vulnerabilities. This examination revealed a reliance on speculative trading that strayed from traditional banking principles. A singular focus on short-term gains fostered an environment where caution was an afterthought. Internal communications unearthed during the inquiry illustrated a disconnect between upper management and the trading floor, as warnings went unheeded amid rising profits. The fallout exposed a web of failures in governance, emphasizing the critical importance of transparency and accountability. Risk management frameworks proved inadequate, lacking the robustness necessary to navigate volatile market conditions. Compliance measures were insufficiently enforced, allowing dubious practices to proliferate unchecked. Regulatory bodies responded with a renewed commitment to reform, igniting discussions surrounding enhanced oversight and the establishment of clearer guidelines within financial institutions. Stakeholders began to understand the necessity of integrating ethical considerations into business models. This introspection set the stage for a transformation in the industry, prompting many to reevaluate their operational philosophies in the aftermath of the Baring Brothers collapse. The shift in operational philosophies was underscored by the legal ramifications that emerged in the wake of the Baring Brothers collapse. A wave of lawsuits followed, targeting not only the bank itself, but also its executives and board members. Shareholders, facing the loss of significant investments, sought accountability, aiming to recoup their financial damages through legal channels. The legal environment became increasingly complex as various stakeholders entered the fray. Creditors, feeling the effects of the financial turmoil, pushed for investigations into the bank's practices. These inquiries revealed a troubling web of negligence and mismanagement, exposing the deep-rooted issues within the institution. The courts became a battleground for claims, with each case delving into the intricacies of fiduciary duty and corporate governance. Regulatory bodies also intensified their scrutiny, introducing reforms designed to enhance transparency and accountability in the banking sector. As these measures unfolded, it became evident that the repercussions of the collapse extended beyond mere financial loss. The reputation of financial institutions faced a critical examination, challenging the trust that had long been established between banks and their clients. This period marked a pivotal transition for the industry, as the fallout prompted a reconsideration of ethical standards and practices. The legacy of the Baring Brothers served as a somber reminder of the fragility of financial systems, reinforcing the need for vigilance in governance. The Bank of England's intervention during the collapse of Baring Brothers illustrated the complexities of central banking in times of crisis. This institution, tasked with maintaining monetary stability, found itself at a crossroads, faced with the tenuous balance between supporting a failing entity and safeguarding the broader financial system. In this instance, the urgency of the situation demanded swift action, with the bank stepping in to provide liquidity. The decisions made in those critical days revealed the intricate web of interconnectedness that defines banking. While the Bank of England sought to stabilize the market, it was acutely aware of the implications that a complete failure could have on public confidence. The atmosphere surrounding this intervention carried an air of both necessity and uncertainty. As the situation unfolded, the responses from various stakeholders reflected a mixture of anxiety and reliance on the central bank's authority. They anticipated guidance amid the chaos, yet the anticipated assurances were shadowed by the reality of impending insolvency. The uncertainty enveloped the fading company, creating an environment of anxiety among employees and stakeholders alike. Trust eroded as financial reports revealed troubling imbalances, leaving many to grapple with the implications for their livelihoods. It became increasingly clear that job security was slipping through their fingers like sand. Individuals who had dedicated years to this institution faced an unsettling future. Some employees, once proud advocates, began to question their roles within a system they had believed in wholeheartedly. The emotional toll was palpable. Conversations shifted from aspirations to survival as families braced for potential disruption. Stakeholders watched with trepidation, their investments hanging in a delicate balance. The once promising returns were overshadowed by the specter of financial ruin. Board meetings, once infused with optimism, transformed into sobering discussions focused on downsizing and restructuring. Communities tied to the institution felt the ripple effects. Local businesses, reliant on the patronage of employees, faced declining revenue streams. The intricate web of commerce began to unravel as uncertainty cast a shadow over the regional economy. In this fragile environment, the human costs became increasingly evident. Lives were being disrupted, dreams deferred. The collapse of this historical institution was not merely a financial event. It represented a profound disruption to the lives of countless individuals, leaving them to navigate an uncertain future. This disruption extended beyond the confines of financial markets, permeating public sentiment and shaping perceptions of banking as a whole. Trust, once a cornerstone of the banking industry, began to erode significantly. The fallout from the Baring brothers' collapse planted seeds of skepticism among patrons and investors alike. It was not merely the loss of capital that caused concern, but the revelation of foundational vulnerabilities within institutions that were once considered pillars of economic stability. Individuals reflected on their experiences, questioning the integrity and accountability of financial entities. Many felt that their interests had been overlooked, fostering a growing belief that banks operated in a realm detached from the realities faced by ordinary citizens. This sentiment resulted in increased scrutiny of banking practices, leading to demands for greater transparency and regulation. In this new climate, the once unchallenged authority of banks began to wane. Consumers sought alternatives, turning to more community-focused institutions, or even exploring unconventional financial solutions. The implications of Baring brothers reverberated through the industry, prompting institutions to reevaluate their strategies and communication with clients. Confidence was not easily regained, as the specter of past failures lingered, reminding society that stability could quickly dissolve in the face of mismanagement and complacency. The fragile trust in banking faced a long and arduous restoration journey. The consequences of this collapse extended far beyond the immediate aftermath, rippling through financial markets worldwide. Investors observed a pervasive sense of uncertainty, which led to a rapid decline in stock prices across multiple sectors. The unsettling news triggered a sell-off as confidence waned in the stability of financial institutions. Major exchanges, once bustling with activity, displayed stark declines, reflecting a collective apprehension. In this region, banks reevaluated their risk management strategies, leading to tighter lending practices. The interconnectedness of global finance became starkly evident as institutions in distant markets felt the tremors of this failure. Economic forecasts shifted, with analysts revising predictions downward, signifying a potential recession. Many firms, particularly in emerging markets, faced increased borrowing costs as credit conditions tightened. This environment fostered a climate of hesitancy, where capital investments slowed significantly. The repercussions also extended to consumer confidence, with households becoming more cautious in their spending habits. Amidst these challenges, regulatory bodies responded by implementing measures aimed at stabilizing the financial system. Scrutiny intensified, with calls for greater transparency and accountability within the banking sector. The reverberations of this event underscored the vulnerabilities inherent in global finance, as institutions grappled with the implications of a shattered trust. Lessons learned from this decline resonate through the corridors of financial institutions worldwide. The collapse highlighted the critical need for robust risk management frameworks. As this historical bank faltered, it became evident that excessive leverage combined with insufficient oversight could lead to catastrophic consequences. The legacy serves as a cautionary tale about the perils of complacency within a rapidly changing market landscape. In response to the lessons imparted by the downfall, financial regulators began to implement stricter guidelines aimed at enhancing transparency and accountability. This region of the banking sector witnessed a shift towards more stringent capital requirements, fostering a culture of prudence and vigilance. Institutions recognized the necessity of diversifying their portfolios, reducing their exposure to singular, high-risk ventures. The examination of Baring Brothers' practices revealed the importance of corporate governance and the dangers posed by entrenched management. This scrutiny prompted boards to prioritize oversight and establish clearer lines of communication. Financial education became paramount as institutions invested in training programs designed to instill a deeper understanding of market dynamics among their staff. The legacy of this failure endures, serving as a reminder of the fragility of financial systems. It underscores the necessity for continuous adaptation and vigilance in an ever-evolving economic environment where the lessons of the past guide the decisions of the present. The landscape of banking regulations experienced a profound transformation following this event. An urgent need for reform manifested as policymakers and regulators sought to address the vulnerabilities exposed by this failure. Increased scrutiny replaced complacency, with a focus on ensuring that financial institutions maintained sufficient capital reserves to weather economic storms. This region saw the introduction of more stringent guidelines aimed at enhancing transparency and accountability. Institutions were required to adopt clearer risk management frameworks, a shift that aimed to prevent similar crises from unfolding. They embraced a culture of compliance, prioritizing the establishment of robust internal controls over the previous, more relaxed approaches. In the aftermath, oversight bodies emerged with renewed vigor, fostering a climate where collaboration between regulators and banks became paramount. This collaboration sought to establish a more resilient financial system, one that could better withstand shocks while safeguarding public trust. The financial sector adjusted to these changes, with many institutions investing heavily in technology and risk assessment tools to adhere to the new mandates. The once unyielding practices of the past gave way to a more cautious ethos. This evolution marked a significant departure from previous norms, reflecting a collective recognition of the fragility inherent in the global banking system and the imperative to evolve continuously in response to unpredictable economic dynamics. The intricate structure of corporate governance at this institution revealed underlying vulnerabilities. Oversight mechanisms intended to uphold financial integrity often fell short as the board engaged in complacent practices. Executives operated with minimal scrutiny, leading to decisions driven by ambition rather than prudence. The absence of rigorous risk management frameworks allowed unchecked speculation to flourish. Decision-making processes became increasingly insular, isolating the institution from critical external perspectives. This detachment contributed to an environment where dissenting voices regarding high-risk strategies were muted, stifling necessary discourse. The culture within these walls fostered a sense of invulnerability, further blinding leadership to the looming threats that accompanied excessive leverage. As losses mounted, these flaws in governance became evident. Shareholders, initially supportive, grew concerned as transparency waned. The tight-lipped nature of executive communication left stakeholders questioning the true state of affairs. This gap between perception and reality widened, eroding trust and confidence. The evolution of risk management emerged as a direct response to the disintegration of confidence within the financial sector. It became clear that the systems in place were insufficient, revealing gaps that allowed for unchecked vulnerabilities. New frameworks were developed, emphasizing the importance of rigorous assessments and transparency. These changes were driven by a collective recognition that effective oversight was critical in preventing similar failures. Regulatory bodies began to impose stricter guidelines, mandating enhanced disclosure requirements and stress testing. This region saw a shift toward a more analytical approach, focusing on quantitative metrics to gauge potential threats. Risk managers adopted sophisticated models to forecast potential downturns, integrating diverse data sources to create a more comprehensive view of exposure. The emphasis on a proactive stance over a reactive one took root. Organizations invested heavily in technology, employing advanced algorithms and real-time analytics to monitor market fluctuations. They recognized that the landscape was constantly shifting, necessitating a dynamic response to emerging risks. Training programs for staff were established, fostering a culture of awareness and vigilance. Despite these advancements, the remnants of past failures lingered. Institutions grappled with the challenge of balancing innovation with caution. The legacy of Baring Brothers served as a sobering reminder of the fragility inherent within the financial system, influencing practices for years to come. The influence of Baring Brothers' collapse reverberates throughout the landscape of investment banking. This historical failure revealed vulnerabilities that reshaped perceptions of risk and accountability within the industry. Institutions began to scrutinize their practices more closely, adopting stricter regulatory frameworks in an effort to restore confidence among investors and the public. The aftermath fostered an environment where transparency became paramount, as financial institutions recognized the need to cultivate trust in a fundamentally interconnected world. Consequently, investment banks evolved, integrating more rigorous risk management strategies into their operations. The emphasis shifted toward comprehensive assessments of market conditions and potential threats. This proactive approach aimed to mitigate the impact of unforeseen events, ensuring that firms were better prepared to handle turbulence. A cultural transformation emerged, prompting leaders to prioritize ethical considerations and long-term sustainability over short-term profits. Innovation flourished in response to these lessons. Technological advancements began to redefine the sector, offering new tools for analysis and decision-making. Algorithms and data analytics became indispensable in identifying potential pitfalls before they escalated into crises. As the financial landscape continued to change, the specter of Baring Brothers lingered, serving as a cautionary tale. The lessons learned from its downfall remain etched in the fabric of investment banking, shaping a future where resilience is paramount. The legacy of Baring Brothers extends beyond its own decline, permeating the very essence of modern banking practices. A foundational principle now adopted by many institutions is the necessity for stringent risk management protocols. The catastrophic losses experienced due to unchecked trading activities underscored the importance of comprehensive oversight. Many banks today employ advanced risk assessment tools to monitor and mitigate potential threats, ensuring that such vulnerabilities remain in check. This region of financial history also spotlighted the significance of transparency. The opaque practices that characterized the operations of Baring Brothers led to a renewed emphasis on open communication and accountability within financial institutions. Regulatory frameworks have since evolved, fostering environments where transparency is not merely encouraged but mandated. In addition, the concept of diversification became paramount. The downfall of a singular focus on high-risk investments prompted a shift towards balanced portfolios. Institutions strive to distribute risk across various assets and sectors, shielding themselves from the volatility that plagued their predecessors. These ruins of a once mighty bank serve as a somber reminder of the consequences of complacency. The principles derived from the fall of Baring Brothers continue to echo through the halls of contemporary finance. The enduring influence of its history shapes the strategies employed by modern banks, guiding them toward a more stable future in an ever-evolving landscape. The events surrounding Baring Brothers serve as a profound reminder of the critical importance of transparency in banking. This institution, once a beacon of financial prowess, experienced a gradual unraveling, largely attributed to a lack of openness in its operations. The concealed risks taken by its traders created a veneer of stability, masking the underlying vulnerabilities that would. In the corridors of this historic bank, decisions were made in isolation, shrouded in secrecy. The culture that developed prioritized short-term gains over long-term sustainability, reflecting a disconnect from the broader financial community. This environment fostered a sense of complacency, allowing significant risks to accumulate unnoticed. The lessons gleaned from this decline resonate throughout the financial sector. Transparency is not merely a regulatory requirement. It is a fundamental pillar that supports trust and integrity in banking. An open exchange of information cultivates a culture of accountability where stakeholders are informed and engaged. As the remnants of Baring Brothers fade into memory, it becomes increasingly evident that the banking industry must embrace transparency. By doing so, they can prevent the repetition of past mistakes and navigate the complexities of modern finance with a clearer understanding of the risks involved. In this region of financial history, the echoes of caution remain, urging vigilance. The role of whistleblowers emerges as a critical element in safeguarding financial institutions from impending failures. Individuals within organizations often possess unique insights into practices that may not align with ethical standards or regulatory requirements. This quiet vigilance can serve as an early warning system, alerting stakeholders to potential risks before they escalate into larger crises. In instances where transparency falters, these courageous individuals step forward, risking their careers to uphold integrity. Their revelations can illuminate areas of concern that might otherwise remain obscured, fostering an environment of accountability. This proactive approach enables companies to address vulnerabilities and implement corrective measures, mitigating the likelihood of catastrophic decline. The impact of whistleblowing extends beyond individual institutions, influencing the broader financial landscape. Regulatory bodies often rely on these disclosures to enhance oversight mechanisms, creating a framework that supports ethical conduct and systemic resilience. Trust is restored, albeit slowly, as communities witness a commitment to rectifying past mistakes. In a sector that can often prioritize profit over principles, the presence of these voices is invaluable. They remind us of the need for vigilance and ethical responsibility, ensuring that the lessons learned from historical failures are not forgotten. Their contributions remain essential in shaping a more stable and transparent future for financial institutions. The environment within this fading institution shifted dramatically as uncertainty permeated its halls. Employees, once proud to be part of a venerable establishment, found themselves grappling with anxiety and fear. Many reported a palpable sense of impending doom, as whispered conversations about layoffs and financial instability filled the air. The psychological toll was profound, transforming the workplace into a landscape of unease. Morning meetings became rituals of dread, with employees exchanging furtive glances, each silently wondering if they would be the next to receive the dreaded news. Long-standing relationships fractured under the weight of worry, and camaraderie gave way to isolation. Colleagues who once celebrated successes together now hesitated to share their thoughts, fearing judgment or scrutiny. Some took refuge in denial, clinging to the hope that the tide would turn, while others plunged into despair, unable to reconcile their future with the legacy of the organization. Reports surfaced of increased instances of anxiety and depression, as the once vibrant atmosphere soured into one of resignation. These individuals, who had dedicated their lives to the institution, faced an uncertain future, their identities intertwined with the very foundation that was crumbling beneath them. The psychological impact extended far beyond the office, reaching into their personal lives, reshaping the aspirations of many. The fallout from the collapse of this venerable institution marked a significant turning point in the ethical landscape of banking. It fostered a growing awareness of the importance of corporate governance, transparency, and accountability. The once unexamined practices of the financial world began to be scrutinized, as the repercussions of the failure illuminated the vulnerabilities inherent in unchecked ambition and risk-taking. This region saw a gradual but palpable shift in the values upheld by financial institutions. Conversations around ethical banking practices became more prominent, transforming the professional discourse into one that prioritized integrity over mere profitability. As this shift unfolded, many began to view the financial sector through a more critical lens, questioning long-held assumptions about risk management and oversight. Simultaneously, educational institutions revised their curricula to incorporate lessons from the collapse. Future bankers were encouraged to consider not only the financial implications of their actions, but also the broader societal impact. This reorientation marked a departure from a culture that had previously celebrated aggressive competitiveness without sufficient regard for ethical considerations. The emergence of regulatory changes reflected this evolving mindset, as policymakers recognized the necessity of safeguarding the financial system from similar failures. A new era dawned, one that sought to reconcile profit motives with ethical responsibility, redefining the relationship between banking institutions and the communities they served. The evolving landscape of finance intersected with the relentless advance of media, which began to scrutinize the inner workings of institutions like Baring Brothers. Coverage intensified as early warning signs emerged, highlighting precarious investments and questionable risk management practices. The press, driven by a quest for transparency, dissected the bank's strategies, elucidating the complexities of its financial dealings for a growing audience eager for understanding. Analysts and industry experts analyzed the bank's missteps, providing a platform for public discourse that was both critical and informative. This scrutiny was not merely a reflection of the bank's decline, but also a broader commentary on the financial sector's vulnerabilities. The portrayal of Baring Brothers shifted from an esteemed institution to a cautionary tale, encapsulating the consequences of negligence and hubris. Television broadcasts and print articles painted a vivid picture of a once revered entity grappling with insurmountable challenges. Reports detailed the bank's entanglements with emerging financial markets and the resulting fallout, cultivating a sense of urgency among stakeholders. As the situation deteriorated, the media's role became increasingly significant, serving as a conduit for public concern and awareness. In the aftermath, the legacy of Baring Brothers continued to reverberate, influencing regulatory changes and shaping perceptions of financial ethics. This collapse became a pivotal moment in the relationship between banking and society, marking a profound shift in accountability. A comparative analysis reveals distinct characteristics in the decline of Baring Brothers alongside other banking failures. This institution's fall, precipitated by unchecked risk-taking and a lack of oversight, mirrors the trajectories of several notable financial entities. The collapse of Lehman Brothers, for instance, occurred under similar circumstances, where excessive leverage and inadequate risk management. Another comparison can be drawn with Washington Mutual, which succumbed to subprime mortgage exposure. While the specifics of the crises differed, the underlying issues of corporate governance and regulatory failure echoed throughout. In each instance, a prevailing hubris fostered a culture resistant to scrutiny, leading to catastrophic consequences that rippled through the wider economy. The aftermath of these failures highlighted a critical need for reform and oversight. Baring Brothers, along with its counterparts, shifted the perception of banking from that of a stable institution to one vulnerable to the whims of human oversight and market dynamics. This shift engendered a climate of skepticism, prompting regulatory bodies to reconsider the frameworks governing financial institutions. The erosion of trust that followed these collapses fundamentally altered the landscape of banking, embedding a more cautious approach within the fabric of the industry. The role of ethics in financial decision-making emerges as a significant theme in the aftermath of Baring Brothers. Instances of reckless behavior and disregard for regulatory frameworks highlighted the consequences of prioritizing profit over principled conduct. This historical banking institution, once revered for its longevity, became emblematic of the perils associated with ethical lapses within the financial sector. A culture that incentivized aggressive trading strategies often overshadowed the responsibility that accompanied such actions. The actions taken by individuals within this firm exemplified how short-term gains could lead to catastrophic failures, affecting not only the organization, but also the broader economy. Ethical considerations were frequently neglected in favor of personal ambition, revealing a troubling disconnect between the ideals of responsible banking and the reality of financial practices. In retrospect, Baring Brothers serves as a cautionary tale, prompting a reevaluation of the ethical frameworks guiding financial institutions. The events surrounding its collapse initiated discussions on the imperative of integrating ethical standards into decision-making processes. Organizations began to recognize that fostering a culture of accountability could mitigate risks and enhance resilience. The importance of transparency and integrity became clearer, reinforcing the notion that ethical behavior must be interwoven with the operational strategies of financial entities to safeguard against future vulnerabilities. The aftermath of the collapse left behind a fragmented identity, one that sought reconstruction in an environment marked by skepticism. Efforts to rebuild the brand involved a meticulous assessment of its legacy and the values it once represented. The once revered institution now faced the daunting task of reestablishing trust among stakeholders and potential clients. Leadership initiated a series of strategic pivots, emphasizing stability and reliability. Initiatives were launched to enhance corporate governance, signaling a commitment to ethical practices. This included the introduction of comprehensive training programs focused on risk management and compliance, aimed at instilling a new organizational culture. Engagement with external advisors and industry experts further bolstered their efforts, as the leadership sought to align the reimagined brand with contemporary standards of conduct and transparency. Public relations campaigns were carefully crafted to communicate these transformative changes. They highlighted testimonials from former clients who had remained loyal despite the tumult. This region, once synonymous with prestige and financial acumen, began to inch toward rehabilitation. As the business navigated the turbulent waters of public sentiment, the gradual reformation of its image relied on the delicate interplay of accountability and renewed purpose. Steadily, the remnants of this storied institution began to resonate with a new generation, seeking to redefine its place within the financial landscape. Regulation emerged as a pivotal force in shaping the trajectory of financial institutions. In the wake of crises, government intervention often appeared as both a lifeline and a source of contention. This region, marked by the presence of numerous banking failures, witnessed the implementation of stringent measures aimed at curbing reckless practices. Regulatory bodies sought to restore confidence in the system, emphasizing transparency and accountability. Legislation took form in response to the increasing complexity of banking operations, with an emphasis on risk management and consumer protection. The introduction of capital requirements and stress testing became standard protocols. These regulations aim to ensure that institutions retain sufficient liquidity to weather financial storms. Yet, the effectiveness of such measures often fluctuated, influenced by the ever-evolving nature of the markets and the institutions themselves. Instability persisted as institutions grappled with the dual pressures of compliance and profitability. The delicate balance between fostering innovation and imposing restrictions remained a topic of ongoing debate. Critics argued that overregulation stifled growth, while proponents underscored the necessity of oversight to prevent future collapses. In this landscape, the interdependence between government and banking institutions became increasingly pronounced, illustrating a complex relationship rooted in shared risk and responsibility. The historical context of these dynamics serves as a reminder of the challenges inherent in maintaining stability within the financial sector. Influence extended far beyond its operational years, marking a significant turning point in the landscape of banking. The practices and eventual failures of this institution prompted a reevaluation of regulatory frameworks. A series of reforms emerged in response to the vulnerabilities exposed by its collapse, reflecting a growing awareness of the need for greater oversight in financial dealings. This region, once dominated by a singular financial entity, began to witness the gradual introduction of stricter governance measures. The lessons learned from the mismanagement and risky behaviors exhibited by Baring Brothers became critical case studies for policymakers. The establishment of more robust capital requirements sought to ensure that banks maintain sufficient reserves, thus protecting against the kind of liquidity crises that had culminated in their downfall. The ripple effects also influenced the formation of more comprehensive risk assessment protocols. Financial institutions were increasingly urged to implement detailed evaluation processes for their investments. The climate of accountability strengthened, reflecting a collective move towards transparency. As the industry adapted, the ethos of banking began to shift. This inclination towards reform not only reinforced public trust, but also underscored the necessity of prudence in financial practices. The legacy of Baring Brothers, though marred by failure, contributed to a more structured and resilient banking environment in the years that followed. The aftermath of Baring Brothers reverberated throughout the banking industry, prompting a reevaluation of risk management practices. This period saw a marked shift in the approach to mergers and acquisitions, with institutions becoming increasingly cautious. The once prominent firms' collapse served as a cautionary tale, demonstrating the vulnerabilities inherent in unchecked speculation and lack of oversight. In response, banks began to prioritize due diligence, emphasizing the importance of thorough assessments before any merger or acquisition. This focus on rigorous evaluation fostered a culture of conservatism, steering financial entities away from reckless pursuits. Consequently, many institutions sought to fortify their balance sheets, often opting for partnerships that promised stability over those that appeared lucrative but risky. The regulatory landscape was also reshaped, as authorities introduced measures aimed at enhancing transparency and accountability. These adjustments influenced the dynamics of corporate transactions, making it imperative for banks to navigate an increasingly complex environment. Transactions that once unfolded with relative ease now required meticulous planning and legal scrutiny. As a result, the frequency of mergers and acquisitions saw a gradual decline, with many firms opting to strengthen organic growth strategies. This shift led to a slow but steady transformation in the banking sector, one that prioritized sustainability and resilience over the pursuit of swift profits. The echoes of Baring Brothers lingered in the decision-making processes of future financial endeavors. The legacy of Baring Brothers shaped the landscape of financial education and awareness in profound ways. Respected institutions began to incorporate the lessons learned from its downfall into their curricula, emphasizing the importance of risk management and ethical practices. It became apparent that understanding the delicate balance between ambition and prudence was vital for future generations of financiers. In this region, seminars, workshops, and case studies emerged, highlighting the pitfalls encountered by Baring Brothers. Prospective bankers were trained to evaluate not only the potential for profit, but also the broader implications of their decisions on the financial system as a whole. These educational initiatives served as a reminder of the fragility inherent in high-stakes finance. Professional organizations adopted stricter guidelines and best practices, fostering a culture of accountability. The failures of this once great institution prompted a reevaluation of regulatory frameworks, leading to enhanced oversight mechanisms designed to prevent similar collapses. The stories of the individuals impacted by the bank's collapse were interwoven into discussions surrounding financial ethics, guiding future leaders in their conduct. This awareness resonated deeply within the industry, ensuring that the consequences of Baring Brothers' demise would not fade into obscurity. Their legacy, though marked by failure, became a cornerstone for a more informed and cautious approach to finance. The evolution of investor confidence in banking shifted significantly in the aftermath of the collapse of Baring Brothers. This historical moment catalyzed a wave of introspection within financial institutions and their clientele. The abrupt end of a centuries-old banking institution revealed vulnerabilities that had previously gone unnoticed. Investors, once brimming with trust, found themselves navigating a landscape filled with uncertainty and skepticism. Regulatory bodies responded to the crisis by implementing stricter oversight mechanisms. These measures aim to enhance transparency and reduce risk, fostering an environment wherein trust could gradually be rebuilt. The introduction of comprehensive risk management frameworks became commonplace as institutions sought to reassure stakeholders of their stability. The culture of risk-taking began to yield to a more conservative approach, where thorough due diligence was prioritized over aggressive expansion strategies. Public sentiment toward banking saw a notable shift. A growing awareness of the complexities of financial instruments emerged, leading to a demand for education and clarity. Investors became more discerning, often scrutinizing the practices and strategies of financial institutions with a critical eye. This transformation underscored a broader societal change, where the repercussions of Baring Brothers' demise resonated throughout the industry. As confidence cautiously returned, it was tempered by the lessons learned from this significant chapter in banking history. This significant chapter in banking history underscored the necessity for robust technological frameworks. Financial institutions began to adopt advanced systems designed to enhance risk management and bolster transparency. It became evident that integrating technology into everyday operations would be crucial in identifying vulnerabilities before they escalated into crises. Data analytics emerged as a critical component, allowing banks to sift through vast amounts of information. These tools provided insights into market trends, customer behaviors, and potential threat vectors. By employing predictive modeling, institutions could foresee shifts in the financial landscape, enabling them to mitigate risks and safeguard their assets. Cybersecurity also took precedence, as the digital age introduced new vulnerabilities alongside its advantages. Enhanced security protocols and the implementation of encryption technologies aimed to protect sensitive information from breaches that could undermine public trust. Financial institutions invested heavily in securing their online platforms, ensuring that customer data remained safeguarded against emerging threats. Regulatory bodies, influenced by past failures, championed the adoption of technology as a means of oversight. Compliance became more streamlined through automated reporting systems, ensuring adherence to evolving standards. This shift not only aimed to prevent future failures, but also to instill a sense of stability within the financial sector. The landscape of banking began to reflect a future where technology would serve as an essential bulwark against the specters of previous downfalls. The case of Baring Brothers serves as a pivotal study in business school curricula, illustrating the intricacies and vulnerabilities inherent within financial institutions. It embodies a cautionary narrative, highlighting the consequences of mismanagement and the perilous allure of unchecked risk. The institution, once a stalwart of British banking, fell prey to a series of compounding failures, stemming from a lack of oversight and a culture that prized profit over prudence. Students absorbed the details of the bank's dramatic collapse, examining the actions of rogue traders and the subsequent financial chaos that ensued. Each decision is analyzed with a focus on the implications of poor governance and ethical lapses that led to the eventual demise. This exploration fosters a nuanced understanding of risk management principles, emphasizing the need for transparency and accountability within organizations. The remnants of Baring Brothers serve as a haunting reminder of the fragility that can exist within even the most venerable institutions. Current leaders and aspiring financiers study these lessons, striving to avoid the pitfalls that contributed to such a monumental failure. The echoes of misjudgment and hubris linger in the hallways of academia, urging a new generation to prioritize resilience and integrity in their future endeavors. This case study stands as a testament to the enduring value of learning from the past. In the realm of financial institutions, the absence of a robust crisis management plan can precipitate rapid and irrevocable decline. Institutions must recognize that unforeseen events, whether economic downturns or unforeseen market shifts, can arise without warning. Without preparation, the response becomes reactionary rather than strategic, leading to decisions shaped by panic rather than reason. In this context, crisis management planning serves as a safeguard, allowing organizations to navigate turmoil with clarity. They must identify potential risks, analyze scenarios, and establish protocols that guide responses when crises emerge. Creating a culture of readiness fosters resilience, enabling teams to act decisively under pressure. Historical precedents illustrate the consequences of neglecting such strategies. The financial institutions that falter often exhibit signs of complacency, believing themselves immune to adversity. This illusion creates a vulnerability that can lead to devastating repercussions. In contrast, those that prioritize crisis preparedness can mitigate potential damage, ensuring continuity of operations. Training and simulations enhance an institution's ability to handle crises effectively. Practicing responses to various scenarios instills confidence and sharpens skills within teams. Over time, this proactive approach transforms into a fundamental aspect of an institution's identity. The capacity to respond with composure can. The cultural narratives surrounding the fall of Baring Brothers reveal a complex interplay of historical expectations and modern realities. This institution, once a pillar of British banking, was steeped in a legacy that emphasized stability, reliability, and prestige. It resonated with the British ethos, a symbol of success and a testament to the power of traditional finance. The unraveling of this financial giant did not occur in isolation. It reflected broader societal shifts and changing attitudes towards risk. Within this region, stories began to emerge, highlighting the juxtaposition between the bank's storied past and its eventual demise. The narratives often focused on the hubris of leadership, where a long-standing reputation failed to adapt to the evolving market landscape. The willingness to embrace innovation was overshadowed by an adherence to outdated practices. As the bank faced mounting pressures, the cultural expectations of accountability and transparency became paramount. This shift in perception underscored a collective yearning for stability, fostering a sense of betrayal among stakeholders. The gradual exposure of internal mismanagement painted a stark contrast to the once glorious image of Baring Brothers. These ruins serve as a reminder of the fragility inherent in institutions once deemed invulnerable, illustrating the delicate balance between tradition and adaptability in the face of inevitable change. The lessons derived from this historical decline resonate within contemporary financial discourse, emphasizing the importance of vigilance and adaptability. The narrative of Baring Brothers reflects a cautionary tale for modern institutions, underscoring the consequences of complacency. Financial professionals analyze its missteps to inform current practices, ensuring that the mistakes of the past are not repeated. Regulatory frameworks have evolved, yet the core principles of risk management remain paramount. Discussions surrounding systemic risk often reference the bank's collapse, serving as a case study for both scholars and practitioners. The interplay between innovation and regulatory oversight is scrutinized, illustrating how unchecked ambition can lead to unforeseen consequences. In this region of financial analysis, Baring Brothers embodies the complexities of maintaining a balance between tradition and innovation. The bank's legacy prompts ongoing debates about the responsibilities of financial institutions to their stakeholders and the wider economy. This dialogue is perpetuated in academic research, industry conferences, and media discussions, reinforcing its place in the collective consciousness of finance. The remnants of Baring Brothers remind observers of the broader implications of corporate governance, risk assessment, and ethical practices. As newer institutions emerge, the specter of its failure continues to loom, urging vigilance and reflection in an ever-evolving financial landscape. This impending decline serves as a reminder of the delicate balance within the banking sector. The historical trajectory of this institution reveals critical lessons for upcoming generations navigating an increasingly complex financial environment. It is essential to acknowledge that success is often built on resilience, adaptability, and an awareness of market dynamics. The rise and fall of this venerable bank illustrate the dangers of complacency. Decision makers must recognize the importance of innovation, coupled with prudent risk management. The legacy left behind highlights the necessity of maintaining ethical standards and robust governance practices. Transparency and accountability emerge as essential tenets in fostering trust and stability within financial systems. In a world where technology reshapes the banking landscape, it is imperative for new institutions to harness the potential of digital solutions while remaining vigilant against the pitfalls of over-leverage and speculative ventures. The lessons from this fading entity emphasize the value of a diversified portfolio and the need for strategic foresight. Cultivating a culture that prioritizes long-term sustainability over short-term gains becomes increasingly vital. The historical narratives surrounding this institution serve as a powerful testament, urging future bankers to embrace a holistic approach that harmonizes innovation with time-tested principles. Understanding these dynamics will be instrumental in shaping resilient financial ecosystems for generations to come. The repercussions of this decline resonate deeply within the annals of banking history. A once mighty institution, it served as both a benchmark for success and a cautionary tale for future generations. Its legacy, marked by both innovation and hubris, emphasizes the delicate balance required in financial stewardship. The intricacies of its operations, the ambitious strategies pursued, and the eventual miscalculations present a multifaceted view of risk management. In this region, the remnants of Baring Brothers linger, a silent testament to the impermanence of financial power. The lessons drawn from its collapse inform current banking practices, shaping regulatory frameworks and risk assessment methodologies. They illustrate the necessity for transparency and prudent governance, underscoring the principle that no institution is immune to failure. These ruins of a storied past echo in boardrooms and financial institutions around the world. The downfall prompts ongoing discussions regarding ethical practices, corporate responsibility, and the importance of maintaining public trust. It serves as a reminder that growth should not eclipse vigilance. The enduring impact of Baring Brothers manifests in the evolution of banking culture, influencing both policy and public perception. As the financial landscape continues to evolve, the shadows of its history remain present, guiding the principles that govern today's banking systems and fostering a more resilient future.